To the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, founder of Trading Trader, AJ Brown. Good morning, AJ.
Hey, Sip. Good morning.
Good morning. Happy July 29th. And you know what I was thinking the other day? We did this episode on the summer doldrums, and I'm seeing all the market action, and I'm like, what summer doldrums? Like, there's a lot going on right now. Where do we begin?
I know, right? I mean, let's talk about just this past week. There's the inflation. Is it still a big deal? I think it is. Fed interest rate hike. They went up another 3/4 of a point.
Well, let's talk about that for a moment
Okay.
because that's what the market was expecting. And it seemed like there was some good chatter or at least follow-up discussion about this. Oh, we're not in a recession. The economy is going well, moving along.
Right.
And a 75-point basis move, that's a big move. And the market reacted very well. Like
Positively.
stocks across the board are just, ripping.
Well, and the scoop is that, the market is very forward thinking. And they're very speculative. And so the market had already priced in a 3/4 rate hike. So if, for instance, the Fed would have done something different, the market would have had to react on the spot. But they had been, the past 3 weeks, they had been pricing in a 3/4 point rate hike. And, the Fed came in right on target with what the market had already thought was going to happen. So the market was happy that they got it right.
And so now we don't know what's going to happen next, right? The next couple of weeks, we're trying to figure out if it's going to be a quarter, if it's going to be a half, right? Like we need the next
Yeah.
data sets to come out to help, affect that decision.
The next Fed meeting is going to be at the end of September. I have it written down here. It's going to be September 20 and 21. So we've got a good month and almost 2 months here that we're going to be just coasting along. And so people are going to pay attention to all these different reports that signal at inflation. I mean, what you got to understand is that when we talk about returns, right, we talk about things like the nominal return and the real return. Like, for instance, if you get a 20% increase in your paycheck, that looks really good. That's called a nominal gain or a nominal return. But then you have to factor in inflation, which is it's hard to figure out what that number actually is. We get these different economic reports and they could be up here or down here. The Fed likes the personal consumption expenditures number. All that is well and good, except for that's based on kind of some historical data and going through this pandemic and then having this conflict in the Ukraine stirring up some of these variables. A lot of those indicators don't really tell us the true picture. So the Fed is the real return you're getting is when you factor in inflation. So if prices went up 25% and your paycheck went up 20%, you're actually now losing 5%. So even though it looks good on paper, your spending power is less. The Fed is trying to align this interest rate with the actual inflation rate, because when they do that, they can get things to simmer. But figuring out this inflation rate is like throwing, darts in the dark.
Yeah, and maybe even it being a supply demand issue, that them continuing to raise interest rates is only one way to tackle the issue.
Yeah.
But following that interest rate decision, we did have GDP numbers that came out and they were negative. And so the argument yesterday is, are we in a technical recession? And then the definition of a recession is being
That's right.
thrown around there. And I don't know. Do you think we're in a recession technically?
No.
No.
And so the technical definition is 2/4 of retraction in the markets. And so we've had that. So technically, yeah, except for that's again based on historical data. Think about what's been happening. So we had this pandemic where the whole globe shut down. And so, for instance, we started to buy stuff at home. We were stuck indoors and we were buying things online and having them shipped to our house. And there was a big market for stuff. And now the pandemic, it's still around, but people know how to deal with it better. And so now all of a sudden, all that extra money is going towards services. But all those people, all those vendors, right, like a Walmart and a Target, they were trying to figure out, it's all about guessing what the future will be. They were trying to figure out, what should we buy now in order to make sure we're ready for the next season? And they overbought because there was so much demand for goods during the pandemic. So this GDP number, if you dig down deep, it tells us that those big vendors didn't buy goods this time around because they had so much inventory for the last time. And so that showed kind of a reduction in our gross domestic product. But in reality, it's just this big bump filtering through the system. And it's going to, if you imagine a stone being dropped in the middle of a lake, and what you see at first is a big ripple, and then the ripples start getting smaller and smaller till finally it flattens out. We're just dealing with the after ripples right now. And so the after ripple made the GDP look negative, but it's not negative when you dig down deep and you factor out some of these inconsistencies. So make sure, it's funny because the mainstream media, and I hate to point my finger at them because they get a lot of crap, but they sure do pick on headlines, right? And they picked on this GDP being negative and the fact that we might be in a recession. But when you dig down deep, you know that that's not the case. So I hope, a lot of the everyday investors are not swayed by that, but I think they are.
And is there a risk with us teetering near, a little bit up, a little bit down in the GDP for the next couple of quarters? Like, could that be like a soft landing where we're kind of like finding our balance?
I mean, that's what people hope, isn't it? That it's going to be a soft landing and that we don't put ourselves into a full-on recession. The Fed just has to be very careful. What the Fed has said right now is that they're okay targeting speculators, right? So by raising interest rates and what we've been talking about previous weeks, selling bonds, and then most importantly, going out there and talking quite aggressively, even if they're not taking the actions to back up what they're saying, by saying stuff, they're actually inducing change and somewhat of a fear or retraction in the markets. By them doing that, they've made it clear that they're changing kind of their outlook that they've had over the last, say, decade, which is, right, over the last decade, they'd get worried if the stock market and Wall Street and a bunch of speculators were like, whoa, 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 don't do that kind of stuff. Now they're like, you know what? You're on target, and we're going to now benefit for maybe the next couple of years, people who are savers, people who have locked in fixed interest rate loans, and especially they think they're going to benefit everyone, right, with a market reset. I feel like they're going for a market reset. The key for us is to make sure we're always on the correct side of the equation, right? That doesn't mean we have to go get ourselves a saver account. That just means we have to understand that if speculators are going to be selling, then we want to be buying. If speculators are going to be buying, we want to be selling, and vice versa. So if speculators right now are going to be hedging their long positions against risk with options, we want to be in a seller's market of being the ones who sell them those options.
Yeah, and we have been seeing a nice rally, at least the last 3 days. Very, very strong buying.
Yeah.
And it kind of plays into some of the discussions we've been having with the are we at a market bottom? It's starting to kind of, I think we've done some Fibonacci retracements where we're now at that 50% mark, or at least we're getting close.
We're actually even more. So we last week, we thought that we had gotten to the top of that Fibonacci and we were just eking out the hints of an uptrend. And if I put back my confirming indicators, so I use what I call just the 3 and 5 swing average. See how we dipped down but didn't cross the 0 line right here? Let me see if I can pull the marker up here. It'll take a second to there it is, Epic Pen. Boop, boop, boop. Okay, it'll take a second to load up, but right here you can see how we coming down to cross at 0, but then we pop back up. That actually is a very good sign for a bottom being found. And when I say that, if I throw my Fibonacci price retracement on this last retracement, so go from here to here, we're clearly more than 125% the previous retracement. I mean, this is the beginning of a bottom. Now, it's not mature. So I'm not going to jump in there and start saying everybody should be buying stocks. What we like to see when it comes to maturity, let me change this around. I'm going to zoom in a little bit. First, I'm going to put my fast MACD. I'm going to go to just a 3-month chart. What we'd like to see moving forward is a couple of retracements down to the 50% line like you were hinting. So for instance, once this current little rally tires, I want to see it pull back to about halfway its previous move. And then I want to see it launch again a second time. If I see those two next moves, what that does for me is that gives me a testing line of support and it gives me a testing line of resistance. I need 2 points SIP on each of those, 2 points at support for me to define a level and 2 tests of resistance for me to define a level. So if I can get a pullback to about 50% and I can then get a expansion, another expansion like we have here where we overshoot 125%. If I get those, then I'm going to say, okay, I've got a mature uptrend. This was clearly a bottom, and going into September, we're on a high. So I'm looking out for that right now during the summer doldrums. This is a nice move. It's making me feel good about the soft landing, but I'm not going to start trading this move. Instead, I'm going to keep trading those moves where I'm going to be looking for sideways movements. I'm going to sell premium, the stuff that our options do best.
Right. Yeah. And the beauty of options is there's strategies for an up market, a down market, a sideways market. And that's exactly what you teach at Trading Trainer and you guys talk about in your mastermind call every week.
Every Thursday.
Yeah. The one thing that I would love your opinion on is in addition to this equities rally, we're seeing rips across the board on the crypto side as well, right? And I don't know if there's a risk factor there where people are feeling more comfortable jumping into those riskier assets. But does it have anything to do with anything else other than just riding the wave?
I mean, right now, there is a mass influx of money going back into savings accounts. That hasn't happened in like a decade, where people could just put their money in a savings account and feel like it's earning some sort of nominal return, even though the real return might be negative. I mean, I just saw an ad for a savings account that was paying 2.25%. And the bonds, right? We talked about this last week. We talked about how the Fed is doing some selling of its bonds. And we talked about China selling a huge chunk of its bonds, which what that does is it makes bond returns go up. So people can now go and take their money and invest it in bonds and earn some really healthy returns. And we're seeing a ton of capital flowing that way. I'm telling you, the Fed put targets on the backs of all speculators. And I would actually throw all of the crypto. I mean, look at what Tesla just did. Tesla was one of the biggest owners of Bitcoin, right? They were using that as a place for all their extra cash so that it could, because companies like to invest just like individuals. And just over the last couple of weeks, Tesla has gotten rid of 3/4 of its Bitcoin owning. meaning Tesla doesn't believe that crypto is going to be the place to hold long-term assets. That's something that we should all take note of, shouldn't we?
Yeah, that, or maybe they just needed the money because they have a very large operation running.
Maybe. I don't know though. They've got a lot of profits, man. They're playing around and Elon's taking some of that money and he wasting it on Twitter, wasting it on not wasting it, but we'll see what happens there. But I think there's a lot of spare cash at Tesla and they're just moving their assets to something that's going to return more. I saw perhaps they're actually even going to be investing in things like gold and bonds instead of crypto. I think it's more of a decision on what's the value of crypto moving forward. Now, I have some friends who are actually in the business of selling crypto. And again, no matter what it is, stocks, crypto, futures, commodities, so long as you're on the correct side of the equation. So if there's a lot of people who are selling, then, maybe now's the time to be buying. But if there's a lot of people who don't know what's happening, maybe you should be on the selling side. So
Yeah,
I know a lot of people in the crypto market who are making a fortune shorting it right now.
sure. Speaking of cars, last week we did talk, or last week or the week
2 weeks ago,
before,
yeah.
I'm not sure. We talked about the credit crunch in the car market. Do you have any updates on that? Or
I absolutely do. It's interesting how many repos, first of all, just as a reminder, this is like a little hidden thing. First of all, $1.5 trillion is now being loaned out in car loans. And this is almost like 2008 playing over again. Now, not in the housing. If you want to look at some sort of similarity for housing, I'd go back to 1978. But for car loans, somehow these car dealerships and car manufacturers, they somehow got their states and the federal government to allow them to give these loans without any sort of um, oversight. And so anybody and their brother, I mean, there was a poll this past week about people who have gotten car loans over the last couple of years, 3 years, and they all almost unanimously said I was able to lie on the application. Right. So anybody can get a car loan. It turns out if you look at the dealer model, dealers are making more money in loans on cars than they are in actually selling cars. The business has kind of changed in the last 5 years so that the dealers want to make loans more than they want to sell cars. And so they've been making these loans up to about 125% of the value of the car, and that's to pay for fees and all of that good stuff. Or and the car values have been very high because, again, of what happened during the pandemic. There weren't chips. There's been a scarcity around automobiles. So all of a sudden people have these overpriced cars. They were getting these loans for up to 125% of those values. They were okay for a few years there because they were able to actually sell these new cars for more. In a normal world, and I keep saying this because it hasn't been normal for like 3 years, but in a normal world, you would expect that the minute you drive off the car lot, your car starts depreciating in value to, on average, when you have had a car for 5 years, it's only worth about 40% of its original value. But that's always been the phrase, right? The minute you drive your new car off the lot, it's worth less. But we've been in bizarro world for the last 3 years. And the values in fact, my mother-in-law just sold her 2-year-old car for way more than she paid for it 2 years ago. And so because of that, people were in this cycle, but it's not something that can last forever. So looking at some of the numbers I wrote down, when it comes to loan defaults, the best state is Utah. 1 in 20 new car loans is in default. That's the best. Then we've got California. 1 in 12 car loans is in default. Texas, 1 in 10 car loans is in default. And then right here where I live, Washington, D.C., 1 in 4 car loans is in default right now. And a car loan only has to be in default about 90 days. So if you don't pay your car payment in 90 days. So it looks like repos are on the highest, mainly in the southeast part of the United States. So if you're in Georgia or South Carolina or Alabama, Florida, there's a lot of repos. The repo mans are very happy. So I'm predicting that this $1.5 trillion that's now loaned out, there's going to be something happening. You got to watch this space, but I think it's going to affect our stock prices. Things like Carvana and all of these new companies that became public in the last couple of years with their new selling model, as well as even the manufacturers. There's got to be, again, we're seeing the ripples. And in this particular case with the cars, I mean, the repos are way up across the country, but especially in the Southeast. And the ripples, it seems like the ripples are getting bigger than getting smaller.
Yeah, and we'll definitely keep an eye on that over the next couple of weeks to see if there's any opportunities,
trading opportunities.
Yeah, any opportunities that we can jump on. And so in this next segment of the show, AJ is going to give us one of his favorite picks, and then we're going to go through some stocks and some analysis from the members through the week and answer any questions. So if anybody watching or listening has a question or has a stock that they want AJ to go over, feel free to drop it into the chat, and we'll see if we can get it on to the show. Otherwise, we'll go ahead and take a little break here. Invite everybody to watch AJ's daily workshop where he goes over a lot of these strategies, and then we'll go through some of these picks. So sit tight. We'll be right back.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. And we're back. When you threw this ticker symbol onto our notes this morning, the first thing that I thought of was this week I saw a lot of Shopify people being laid off. And so you're seeing an opportunity in a very popular, fast-growing e-commerce platform in that being Shopify, ticker symbol SHOP. So AJ, what are you seeing specifically in Shop that you're liking?
So in Shopify, so what we're looking at here is a 3-month chart, but even if I go back to a 6-month chart, you know, Shopify just had their earnings. It's earnings season, by the way. A lot of companies are reporting, you know, this week and next week. The banks have gone through their cycle. So when earnings goes past us, we have a good 3 months to do some sort of strategy on this. And so Shopify, it's been falling. And then around in the beginning of May, it has found itself some legs. It's found a level of support. It's found a level of resistance. So again, if I zoom into just the last 3 months, it looks like it's trading between about $30.50 and about $41. That's a nice channel. And so when we sell premium, just to kind of outlay it, you know, you can sell premium all on the same day. That's called a buy right in the world of covered calls. That means that you buy the stock and then sell the premium on the same day. But that only gives you a certain, you know, locked in return. In fact, when we analyze our trades, what we analyze, get this, everybody, we analyze a buy right done in the center of the channel. Why? Because that's the worst, shittiest trade that you can come up with, is a buy right in the center of a sideways moving channel. So if we analyze that and we understand what the minimum returns and the maximum risk is on that really crappy trade, then by simply buying a little lower and selling our premium and buying our protection a little bit higher, we can really put that trade onto turbocharging. And so I wanted to highlight Shopify, SIP, because this is in one of those patterns that's mature. It looks like, you know, we're right in the center of the channel now. So if you guys would just take a look at analyzing what kind of max returns could I get, and risk would I put on if I did a trade as of right now. And that would give you the baseline, right? We plan for the worst, and then we can only be surprised by better results. So it looks like we're heading back up towards a top. And so plan it out, see what this worst case scenario might be. And then my plan is to buy some back month put options. Once I see it back above this line, right, back above 35.75, more likely up here in the $40 range, I'm going to be thinking about, betting against Shopify. I'm going to go out to probably 2024. So I'm going to get some put options that are going to be around for a while. And I'm going to go somewhat deeper in the money so that these things act more and more like the stock, only in inverse, so that when the stock goes down $1, my back month put option will go up $1. I'm going to buy those things, and then I'm going to allow some time to go by. And once I dip down below my testing case, so probably in a couple weeks, once I'm back down here in the $32 range, that's when I'm going to go ahead and sell my put premium, buy my protective call, and just start this cash machine on Shopify. That's constantly putting ourselves on the correct side of the equation with this particular ticker. I foresee this particular ticker giving us income for months to come.
Quick follow-up question. So seeing as you kind of have zoomed in on, I don't know, looks like the last 3 months,
Right.
do you need to see this type of consolidation and support and resisting forming within like a 3-month span to kind of fit your strategy? Because if you go out, like, it's fallen a lot since, I don't know, last year, the year before.
Yeah.
And so is that a component for you making a decision on a position?
Yeah. So you remember when we were talking about the S&P 500, we said it's not mature yet because we want to see at least 2 tests of support and 2 tests of resistance so that we can actually feel confident about this mature channel direction. Same thing with a sideways channel. I wanted to see a minimum of 2 tests of resistance and 2 tests of support. I've actually had 4 tests of resistance. I've had about 5 tests of support. So yes, does factor into whether I trust in it. And these levels of support and resistance are completely psychological. What winds up happening, think if you put yourself into the avatar of the investor, is they see this level of support. These people who have bought low down here, whenever they see it come back down, more people jump on board and they say, wow, that's been the level that people have been buying at. That must be the lowest level. I'm going to start buying. And it becomes a self-fulfilling prophecy, because what happens when people start buying? It makes the price reverse and go back up. Same thing up at the top. The more times you test a level of resistance, the more people start jumping on board and saying, hey, that's a good price to sell at. It hasn't gone higher than that. I'm going to go ahead and sell here. That looks like the most I can get based on these previous times it's gone up there. And what does selling do? Selling makes the price reverse and start to go back down. So when you have a channel that has been tested a bunch of times, what happens is you get these robust, thick, we call them thick, levels of support and resistance, just because more and more investors pile on, creating these self-fulfilling prophecies. It doesn't mean that it can't break out. It just means that it's harder and harder, more difficult to break out. Sideways channels are more difficult to break out of than even ascending or descending channels. It's just easier for the human brain to figure it out.
Interesting. Love the insight. All right, moving on to our next user question. This is Marion from Casper, Wyoming, looking to get some insight on a darling of last year, maybe even the year before, and that's Pfizer, the maker of one of the COVID drugs. And initially, I was thinking, they had a nice run up the last couple of years, and I'm wondering if they're starting to develop some sort of a sideways channel, because we have been making strides as, a society in battling this outbreak.
Yeah. So I'm looking at 2 years of Pfizer, and just like you described, Sip, All of this was pretty positive for Pfizer. And then they released their vaccine and they released the boosters. They got it all approved on. It just goes to show you that, what's front and center of the general public's mind is what gets the most positive attention or negative attention. And again, the media has a lot to do with that. And so, Pfizer is the main thing behind the COVID vaccine, I think, was not really the COVID vaccine. I think that it was more of the technology, this RNA technology, where they could actually inject something into our own cells, hijack our own cells, and make our cells look like the offender, and then trick our immune system to attack our hijacked in order to create that kind of antibody response. And so I know that Pfizer is using that same technology to treat other diseases. Like, for instance, they're thinking about a full-on flu vaccine that could eradicate the flu. They're thinking about the HIV vaccine, all of that good stuff. But it's not front and center of the mainstream America's mind. Mainstream America was like, is Pfizer going to solve this COVID problem? And so they kind of did. And so now the stock is moving sideways. I think it's a nice, solid symbol. And I particularly like symbols that wind up going back under the radar, because those symbols that go under the radar give me, as an option trader, the potential to turn them into income generators. So if we zoom back in, and I think Marion's spot on with this play. If I go into just the last 6 months, we see the same thing that we saw with Shopify, right? We see it bouncing between support and resistance. So, Marion, right now, it looks like if I throw my ruler onto this thing, if I say that if I identify support or resistance somewhere around this $48 mark and resistance around this $54 mark, and what I can do here, because I like round numbers, so I'm going to go ahead and just knock those out as if they're as round as can be. So 48 and 54, I'm manually putting my ruler on. There we go. So right now, we're right in the middle. We're right around that $51 mark, about $50.25 to about $51.75. This is the perfect time, Marion, for you to be putting together a plan. And what I would do is I would say, okay, if I was to do a buy right now, what kind of returns would I get and what kind of risk would I be opening myself up to? Because that's the worst. That's the worst returns you'll get. That's the worst amount of risk you'll open yourself up to. Because now if it does what it looks like it's doing, it looks like it's coming back down. Instead of doing the buy right in the middle, we'll do the buy down here, and we'll do the right, which is the selling of the premium up here. And just by having that small difference of $2 here and $2 here, you're going to take that risk and diminish it from what its worst case scenario was to probably close to nil. And the rewards, you're probably going to get, over double-digit rewards. And that's in just, doing a couple transactions a month. We're not talking about day trading here or having to get in and get out in the period of a day or two. We're talking about doing one trade. It looks like you do one trade and then about 14 days later do another trade, and all of a sudden you've got a 10% return on your investment. So I like it. I'm going to be watching it too. Thank you, Marion.
Yeah, we'll definitely keep an eye on it because there is still a little COVID different variants chatter all around the globe.
Sure.
So they're definitely going to be involved in
I'll
that
tell you,
discussion.
I started wearing my mask again around here in DC.
Well, the big guy, the big guy in the White House just caught that last one, and honestly, if he can overcome it, I'm personally not going to be too worried.
Yeah, he's an old dude.
But it's good that the numbers aren't as dramatic as the first time around. So that's good that we've found solutions. All right, moving on to our next ticker. This one, I'm curious, just in the sense that if we are going to a recession, do people drink more alcohol when they're in a recession. And we're talking about ticker symbol BUD, and that's Anheuser-Busch. Adam in Golden, Colorado wants to know about this darling here, Anheuser-Busch.
Adam, Golden, Colorado. That's Coors territory, my friend.
Uh-oh.
So you're crossing the boundaries there. No, I've liked Anheuser-Busch. One of the things that I get worried about with Anheuser-Busch is that because it's been acquired or merged with
InBev.
Yeah, it's InBev, but there's a lot of foreign investors. And how do you know that there's a lot of foreign investors? Because there's a lot of after hours trading. You'll notice that it's very rare for ticker BUD to have a closing price and then an opening price the next day. What happens is in the middle of the night, a whole bunch of after hours, big money investors from around the world are buying and selling this outside of the hours. And then when the market opens again, it's a whole different price. So that gives us a little bit of uncertainty because options don't have that. In other words, options are only traded during the market hours that the options are offered on. So if the underlying stock is gapping between yesterday's close and today's open, as option traders, we lose a little bit of certainty. When the market opens, all of a sudden those option prices have to change drastically. And where we think we're winning the night before, we could be drastically losing the next day. With that said, that's if you're trying to trade options directionally. What I talk a lot about is trading options, the influence of time decay on an option price. Options profit in so many different ways. And so I think that you could apply options to Anheuser-Busch and not be so worried about this gapping by using the optimizing your option trades to take advantage of that time decay component. The fact that options like to expire, like a coupon expires with an expiration date. So looking at this chart, I'd want to let me go back. I kind of want to go out a little bit more. So let's go out to say the last 2 years. And so it's had its ups and downs. It looks like it's finding this level of support that it's found a few times over the last 2 years. I would want to see that level of support tested one more time. So going back to kind of our theme of the day is mature channels are where it's at. And if it's not mature, maybe you pass on it until it is mature. You keep it on your watch list, but you look for something that's more mature. I'd like to see this level of $51. I'd like to see that tested one more time before I go anywhere with this. But if it does test at $51, I wouldn't see why it wouldn't be a bad idea to maybe put on some BUD into your portfolio or buy some back month call options actually. And then if it doesn't continue to go up, the minute it stalls, sell some premium to make some money off of that type of trade. That's kind of where I go. It also, coming back to something that Sip said, and it brings up a memory. When I first got into stock and options trading, it was in the late 90s, and you couldn't do wrong. And that kind of reminds me of what happened like from 2018, 2017 to about 2020. You couldn't do wrong, right? Whatever you invested in made money. And then it got overbought. And sure enough, we had the dot-com bust. And I made the smartest investment ever. I bought Hershey's chocolate stock. I bought a whole bunch of call options. Because what do people do when they're depressed? They drink and they eat chocolate. And I made so much money in 2001 on watching Hershey's go up in value with call options. And I feel like depending on what happens with the decision on are we going to go for a soft landing or a hard landing, this could be a perfect hedge, right? Have some, Anheuser-Busch, because if it is a hard landing and people run on hard times, I think beer purchases will be high.
Yeah, the only argument I would throw in there is maybe inflation, right? Like the cost of producing and shipping and all that, because
Mm.
I'm seeing the prices of alcohol go up along with everything else. So
Maybe with this Ukraine conflict, right? Because isn't barley and hops a product that you can get out of the Ukraine?
I think that is one of their larger exports.
But, I've been looking at, speaking of shipping, shipping containers were at an all-time high when we had that supply crunch, like in Long Beach, near where you are, with all the ships piled up. That's pretty much gone down. Shipping containers have come down in price drastically. Um, I think that, just the price of raw ingredients is making beer up. So the answer is instead of putting your money into bud, you should become a bathtub distiller like back in the old prohibition days and make some moonshine in the bath. I just found out that my grandfather was big into that. I didn't realize that, but my grandfather made the moonshine in his bathtub.
I tell you what, if I lived in that era, I definitely would have been a bootlegger.
Oh yeah. Oh yeah, talk about investment. That's a
All right.
great return.
Speaking of inflation, right? We have a question from one of the members, one of the younger audience members of the show, Mr. Manny, is
Ah.
curious to know, and this is a great question. Um, should I stop investing when inflation is high? We talked a little bit about the savings. People are going into savings. That's a form of investing. But what are your thoughts on investing when inflation is high?
All right, so there's passive investing and there's active investing, right? Passive investing is where you put your money into a savings account, you put your money into a bond, you put your money into a certificate of deposit, maybe you put your money even into a mutual fund. That would be considered passive investing. And then there's active investing, which is where you're going to be more active. Real estate is active investing, crypto trading, to stuff like I do, equities and stocks. Manny, now is the best time to be doing your active investing, right? But it's also important that you understand, you know, it's not going to be traditional investing. So everybody's programmed with, I want to buy something and have it appreciate in value, buy low, sell high. But you have to be flexible and you have to understand that we have these investment vehicles that allow us to now make money when the market goes down. So the key is being able to quickly understand what the market is presenting to you that day, that week, that month, and trading accordingly. It's kind of like fitting that puzzle piece to the puzzle. You're not just going to take a random piece out of the puzzle and force it in and hope that it works, because you'll never get your puzzle built. Instead, you're going to find, you're going to pay attention to what all the edges are and all. I don't know if this analogy is working, but all the edges are, and then you're going to find that piece that fits. And the better your tool bag, the more pieces, the more situations you can deal with. That's why I always chose options, right? Because with stocks or with commodities or with a lot of the Forex, for instance, you can only make money when things are going up or when they're going down. Two different ways, right? With options, there's like 26 different ways, right? If the market's going sideways, I can make money. If the market's going up, I can make money. If the market's going down, I can make money. But also I can make money just by putting some, selling or buying some options and allowing time to go by and allowing that value to decay away, right? And I can also make money because options respond to fear and confidence in the market. So if there's going to be a lot of fear, I can do an option strategy that profits on the fear. And if there's going to be some confidence, if people are going to start to get cocky again, then I can make money that way. I just have to get good at analyzing what I'm seeing, look for patterns. And once I recognize a particular pattern, then I just dig into my option trading tool chest and fit it. So now is the best time. And the reason why I say that is because you're going against the trend. The trend is exactly what you're saying, is if inflation is high and the Fed is raising rates, maybe I should take my money and bury it in the backyard. I heard AJ say earlier that speculators have targets on their back. Yeah, they do, but that doesn't mean that with our strategies we can't profit on that. We just have to become the rifle shooters, right? Instead of being the targets, we can be the whatever the opposite of the target is, the shooter.
Yeah. Yeah, and ever since I've started learning about options and your technique specifically, I think the greatest lesson that I've taken away is the power for options to provide value when you have a portfolio, right? When investors have good stakes in good blue chip names that they plan on holding for a long time, options are a great tool to allow you to generate additional income onto that portfolio. And I just love giving everyone that lesson, and specifically for anybody watching that wants to know exactly how AJ does that, jump into that workshop, follow along, see the examples. I know he's updating it every day, every couple of weeks. It's very up to date. And if you like what you see, jump in there, jump in the mastermind group and start putting these strategies to use, because like you said, in an up or down market using options, there's plenty of ways to make money. And that's what's the beauty of Trading Trainer is it allows you to learn, implement a strategy that best fits your style, investment strategy, things like that.
I couldn't have said it better myself.
I
gotta say, every Thursday we have no problem finding another candidate to plan out and get in on, no matter what the market's been doing. I mean, we've been running this particular premium selling program since 2007, and there hasn't been a week that we haven't found a candidate that we can plan out and then put into our portfolio and make a long-term income generator. So that's the beauty of this particular, strategy and outlook on the markets, is it doesn't really matter what the markets are doing. It's how you analyze the market and how you pattern fit it, how you find the right tool to trade what you're seeing today.
Yeah. All right. Well, AJ, with that, I think we're going to go ahead and wind the show down here. As always, if anyone has a question, comment, or concern, feel free to leave it in the chat, send us a DM, and the team will get back to you as soon as you can. Heading into August, I think we're going to have a slower month, but we could be completely wrong. Seeing as how things have been going, we still are in the thick of earnings season, or it's going to be winding down. Nope, we got a lot of earnings
still.
Any final words? Anything that you're keeping an eye on going into next week?
Yeah, there have been some cars that I've wanted that I haven't been buying because they've been crazy priced. It looks like just in the last 2 weeks, some of these car models have dropped 18% in value. So this month of August, this month of September, I'm going to keep my eyes peeled. So if you need a ride, if you need some wheels, you're, maybe hold on a couple more weeks. But I think that with this car crashing market that I keep talking about, people who are in the market for a car who haven't bought one, I think you're going to be getting some good deals on some cars that are less than a year old just in the next couple of weeks. Keep your eyes peeled. Start looking this weekend.
Hey, that's a great tip. If you're in the market for a car, it might be a great time to get one and actually, create some value for yourself. So I'm looking forward to seeing or hearing what you pick up, AJ, if it ends up happening.
I've always dreamt of a Bentley.
Yeah, I see those all over the place, and
where you live,
there's just too much. There's just too much.
Yeah, maybe.
All right, thank you for your time, AJ. Thank you everybody for tuning in and watching the show. If you're enjoying the content, hit that follow, hit that like, hit that subscribe button, and we'll do our best to provide you with quality content every week. All right, AJ, thank you very much, sir. Have a good weekend. Thank you, everyone. Have a good weekend, and we'll catch you next week.
Bye.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.